Alrighty, today we've got a very special show for you guys because today we're going to learn how to use options to boost the performance of our portfolios. And we're going to talk about everything. It's like a beginner's guide. We're going to talk about where you can trade options. We're going to talk about why you should be trading options. We're going to show you how to make money going long, going short, and we're going to show you how to protect your portfolios. All this using a very, very, very innovative and a very, very, very cool model using options. So we're doing this in partnership with our partners here at Deribit. It's going to be a big show. So let's have some fun. Let's do it. Let's do it. Let's do it. All right, listen, if you want to be a master trader, you need to learn how to use options. You can't be a master trader and not know how to use options, because all master traders use options at some point. And there's a very good reason for it. In fact, if you look at the options market is always way bigger than the underlying asset market. And it's going to be no different when it comes to crypto. Now, today, crypto options are relatively small, and retail consumers or retail investors don't really use options as part of their arsenal. And that's why we thought we'd get in there early and we'd teach you guys exactly how to use options to protect your portfolios and to actually make huge returns. And in fact, there really are 4 reasons why you would actually learn to use options. So I've done something for you guys. The first reason why you could use options is to hedge or protect your portfolio. The second reason that you can use options is to speculate, which I know you guys are a bunch of degens. I'm going to show you how to speculate without actually the risk of liquidations every time that you get a wick. Then you can use options to get cheap exposure to an asset class. So if you want to say, for example, buy Bitcoin, but you don't have enough money to buy a full Bitcoin, well, maybe you can use options and you can get exposure to that asset class cheap. And lastly, of course, you can collect fees. So listen, today is a special show. It's brought to you with our partners at Deribit. They are the biggest options exchange. They've been running since 2016, and they are the biggest options trading platform in crypto. If you want to join us and you want to be trading options with us, and I think that the best way to learn how to do something is actually to test it. It's like, you know, when you first bought your first Bitcoin, remember that? And you only really learned how to sell Bitcoin, store Bitcoin, when you did it yourself. So if you want to join us, just go to this video, click on the video, Bitcoin, store Bitcoin, and you can look here in the referral link here. There is a link here to open a Deribit account. Now click on that link, it'll take you to Deribit. Because these guys are the best, and because they're so highly regulated, and because they're so they're so cautious of the law, you do have to do a KYC in order to do the option. So if you haven't done the KYC yet, go and do the KYC. But as I say, I think it's super important for you guys to actually learn like you learn to trade with actually opening an account. It's all very well to see the theory and to watch a tutorial, but if you don't have a Deribit account, then you won't actually be able to trade options with us. And I think there's a lot to learn when it comes to trading options. So let me know in the chat how many of you guys have already got a Deribit account and how many of you guys have already traded options before. And otherwise, just let me know in the chat if you're present. So if you're here on a Sunday doing one of our Sunday classes, then just say present, because Chaos, I see you here. AMG, I see you here. Pranil, I see you here. You know, those that are here on a Sunday learning how to use a brand new tool, adding a new tool in the arsenal, almost a guarantee that you guys are going to make more money than the guys that aren't here on a Sunday. Because if you're here on Sunday school and you're present, well, that's the investment that you make. All right, so let's talk about options and what the hell options even are. And as I said to you, there's a lot of reasons why people use options. People use options, particularly I like the use of options to protect or hedge your portfolio. And options can be on anything. They can be on really any asset. Today we're going to talk about options on crypto, but you know, you can do an option on grain, you can do an option on an equity, you can do an option on absolutely anything. And I guess the next question is, what is an option? So an option is really, I'm going to show you here, it's the right, but not the obligation to either buy or sell an asset at a set price at a future point in time. I know it sounds like a mouthful, but we will go through it a little bit slower in a second. So remember, it's the right, but not the obligation. That's why it's called an option, to buy or sell an asset at a set price at a future point in time. And really, there are 2 types of options. The first option is what they call a call option. And a call option is the right, but not the obligation, to buy an asset at a set price at a future point in time. And then there's a put option, which is the right, but not the obligation, to sell an asset at a set price at a future point in time. So the difference between a put and a call is the right to buy, and a put is the right to sell the asset at a future point in time at a set price. So you kept hearing me say a whole lot of words over and over again. What are the words that we spoke about? Well, let's quickly go then. You can see, because every asset actually has 5 things in common. The first thing that they all have is they all have buyers and sellers. For every buyer, there must be a seller. Otherwise, there's no option. So when there's a call option, there'll be a buyer for the call option and there'll be a seller for the call option. Then, of course, every option is going to have an underlying asset. So it can be Bitcoin, it can be ETH, which is what we're going to talk about today. But it can actually be anything. It can be you can have an option for a Tesla stock. You can have an option for maize. You can have an option for plastic bottles. It's anything to do. An option can be really an option to buy or sell anything. Then, of course, there'd be a price today. So as you know, with Bitcoin, there's a price today. Right now, the price of Bitcoin is 27,887. There is also a strike price of an option. So remember I said to you when we spoke about options, I said at a set price at a future point in time, and we call that the strike price. And then, of course, there's a strike date, which is the date of that future point in time. So all options will have 5 things. They'll have a buyer and a seller. They'll have an underlying asset, which will be Bitcoin or ETH. And today we're going to do a lot of Bitcoin options, but you can trade ETH options. There'll be a price today of the asset. There'll be a strike date in the future, and there'll be a strike price in the future. And I'll show you a very simple example. You can have a Bitcoin call option, which would mean that the underlying asset is, of course, Bitcoin. The strike date, we could say, is 29th December 2023, which is almost at the end of the year. We can have a strike price of $30,000, and you can have a price for the option today, which is $5,000. And if you do go onto Deribit, who are our partners here, and you look at their interface, which is this interface over here, and you press options, you can see it's broken up into Bitcoin options on the one side and Ethereum options on the other side. So remember, every option has an underlying asset. On this side over here, the underlying asset is Bitcoin. And on this side here, the underlying asset is Ethereum. Now, today we're going to talk mainly about Bitcoin. And we are going to do many of these Sunday sessions. We're going to do many of these Sunday sessions specifically around options. I'm going to try and teach you guys how to use tools that we don't ordinarily use. But so in this case, you can click on Bitcoin or Ethereum, but you need to choose a date in the future when the option actually takes effect, or what the strike date is. And for the purposes of this video, let's use 29th of December 2023. Now you can see if I click that, I get this very complicated screen over here, which shows you what the different strike prices over here. And you've got calls on the one side, and you got puts on the other side. Now remember that the difference between a call and a put is very simple. A call is the right to buy an asset at a set price at a future point in time, and a put is the right to sell an asset at a set price at a future point in time. So what I want to do now is, I said to you in the beginning of the stream that there are 4 reasons why people would use options, or why we should use options. The first one I said is to hedge or protect your portfolio. The second one is to speculate without getting liquidated. The third one is to get exposure to an asset point, to an asset class cheap, which is actually speculation. And the fourth one is actually to collect fees. So I actually want to go through each of these scenarios. I want to show you how to hedge your portfolio using options. I want to show you how to speculate or to get exposure to an asset class also using options. And then I'm also going to show you how you can maybe just land up collecting fees for doing very little with options. But it's a risky strategy. And that's one of the things we're going to talk about. But before we do that, I just want to go through a call option with you guys. And I want to make sure that everybody understands how a call option works. So let's look at a December 2023 call option. So we've gone to Deribit. We've gone to the options, because you see Deribit does have futures as well. But in this case, we're going to go to the options. We're going to choose an underlying asset, which in this case is going to be Bitcoin. we're going to go down to Bitcoin. We're going to click on 29th of December, 2023, because we're looking to hedge our portfolios or to speculate towards the end of this year. You can obviously do it much shorter durations. In fact, you can even do it for as soon as next week. But just for now, let's talk about thinking forward until the end of 2023, which is the 29th of December, 2023. And if you click that, as you can see, there's puts and calls. So a call, as I said to you, is the right to buy Bitcoin at a future point in time. And of course, for that right, you would have to pay someone. You'd have to pay the other side who would sell you the option, and he would collect the fee for the option. So let's take a call option on Bitcoin for the end of the year at the same price as we're at today. So just let's say the price right now is 27,941. That's close enough to 28,000 for me. So let's go to 28,000. And we're looking at an option at $28,000, as you can see over there. We've already said that this is on the 29th of December, 2023. And we want to see how much that option would cost us. So if we bought a 28,000 option, the cost is somewhere between, because there's buyers and sellers, like everything in the market, the cost is somewhere between $5,996 and $6,210. So what does that actually mean? It means that if you want to buy a call option, you're going to pay about $6,000 for buying that call option, because that's what the price is. People are selling them at $6,000. What does that mean? It means that you now, once you've bought that, you have the right, but not the obligation, you have the right to buy Bitcoin at 28,000 in a year's time. Okay, so you buy Bitcoin at 28,000 in 1 year time. So you'd only buy a call option if you were really bullish. You'd say, okay, I'm bullish. I think Bitcoin's going to go up. I don't really have enough money to buy full Bitcoin. What I'm going to do is I'm going to buy an option to buy a Bitcoin in a year. Now, you do that because you don't have enough money, or you just want to speculate on the price of Bitcoin without the risk of a wick, without the risk of getting liquidated. Now, we love trading futures with you guys, but we also know that futures are super risky because A, you can get really liquidated. B, you can get liquidated when there's one wick. So the price may go down and then come up again. And then you got liquidated just because the price went down temporarily. That is all eliminated with options, because options don't really care what happens between now and the end of the year. All they care about is on the strike date, which is in this case, the 29th of December, 2023, what is the price of Bitcoin? So they don't care about the wicks and whatever happened in between. They only care about what happened on the end date. So in this case, as I said, you bought an option with a strike price of $28,000 on a strike date of 29th December, you paid $6,000. So what happens? If the price of Bitcoin goes down and the price of Bitcoin, say, goes below $28,000, well, you have the right to buy Bitcoin at $28,000. But if the price of Bitcoin is below $28,000, so say $25,000, why would you buy Bitcoin at $28,000? You wouldn't. That's why they call those options out of the money options. In that case, what happens is you have paid a fee or a premium. You've paid $6,000. And in that case, you've lost your money. Your money's gone. Okay. If Bitcoin goes up and goes up, let's say above $28,000, well, you have the right to buy Bitcoin at $28,000. So if Bitcoin is at $30,000 and you have the right to buy Bitcoin at $28,000 from the person who sold you the option, he has to deliver you a Bitcoin at $28,000. So anything above that price starts to become profit, but it's not pure profit because remember, you've paid a premium for that option. So you've paid $6,000, Bitcoin goes to $30,000, and you now have only made $2,000 here, and you've paid $6,000 for the option, which means that you've lost $4,000. Okay, but if Bitcoin goes to $50,000, that's where it really starts to get interesting. And I'm going to show you some math. I'm going to show you some calculations here of how cool these option strategies actually work and when they come into the money. So let's look at a simple scenario over here. If you are a call option buyer, that means that you're effectively bullish because you're buying the right to buy Bitcoin at a price at a certain point in time. So in this case, what we're saying is, let's look at an option, a $30,000 option. Let's go check it out here. So we can see that a $30,000 option, give or take, is costing around $5,000. For now, let's just make it $5,000. So if you're buying an option, you pay the $5,000. If the price goes down, as I said to you, you lose the $5,000 because you're not going to buy an option. You're not going to buy a Bitcoin at 30,000 if it's trading at 25,000. So it becomes out of the money. If the price goes anywhere between 30 and 35,000, what happens there is you start recouping the premium that you paid. Because remember, you have paid $5,000, because that's more or less the price of the option, to the option seller. Okay. And so you start recouping your money. And after $35,000, it's pure profit. So I made a chart for you guys. I want to show you this chart because I think it actually explains it very, very well. So look here, let's have a look at this chart. Let me just zoom out here. I'm not a presentation king. This actually, I haven't made a presentation in many times. So if we take the price, let's use this axis here as the price. Okay. And we say this is our profit or loss. So if we're buying a option at a $30,000 option, a $30,000 option, and we're paying $5,000, which is more or less what the price is. So we go to there, we go here, we look at the end of the year. Hold on, let me just escape that. So at the end of the year, a $30,000 option will cost me $5,000. I would typically do this because I'm bullish, but I don't have enough money. I don't want to put all my money down on Bitcoin. Then I just buy options. So I pay $5,000 for the option, and look what happens. For as long as the price is under $30,000, I've lost $5,000. You can see that. As long as the price is under $30,000 over here, I've lost $5,000. When the price gets to $30,000, I start making money. So if Bitcoin's trading at $31,000, I make $1,000 because I get the Bitcoin at 30,000 and I can sell it for 31,000. So I start making money. I make about $1,000. But the issue is that I've paid a $5,000 premium. So actually net, I'm still negative. I'm still in a loss here. You see, I'm still in a loss situation. And at 32,000, I'm also in a loss situation. And at 33,000, I'm also in a loss situation. And at 34,000, I'm also in a loss situation. But at 35,000, something happens. I break even. And the reason why I break even is because I have the right to buy Bitcoin at $30,000. The price is $35,000. So I buy the Bitcoin at 30,000. The price is 35. So I've made $5,000. But remember the premium that I paid, the option premium that I paid? Well, now I paid $5,000 and I'm $5,000 in the money. And so from $35,000, I actually start to make money. And you can see if the price of Bitcoin goes to $40,000, I'll end up making $5,000. So remember, my option strike price is 30,000. The first $5,000 go towards repaying the premium that I paid. And then anything above that is actually unlimited profit. So if Bitcoin does go to $1 million, well, I get to make all the upside. And you see my maximum downside was only $5,000. So unlike a leverage trade where it could have eaten my whole portfolio, it could have been closed out or wicked out or whatever else. In this case, that doesn't happen. I put down $5,000 and I get unlimited upside. And of course, if you're bullish, that's the easiest way to get exposure to Bitcoin. So I'll give you a very simple example. Imagine that you believe that Bitcoin is going to go to $1 million, but you don't have enough money to buy Bitcoin. You just don't have enough money today. You don't have $28,000 to buy Bitcoin. You think that at the end of the year, you'll have enough money to buy Bitcoin, but you want to peg the price. So what you do is you take an option and you say, I'm willing to put $5,000 down now, which I have. And then at the end of the year, I'll have exposure to a full Bitcoin. I'll have the right to buy Bitcoin at $30,000, regardless of where the price is. The price is at $1 million. You still get the Bitcoin at $30,000. And if the price is $1 million, then you've made $970,000 profit, less the amount of money you paid for the option, which is $5,000. So it just shows you that unlike futures, you can use options to create a leveraged effect without the risks of being wicked out along the way. And remember, options only care about the strike date. They don't care about anything that happens before the strike date. You can't be stopped out of buying an option. Let me just escape from there. Before the strike date. So that's an example. Let me show you something else. That's a call option. Now, remember, if you're buying a call option, then there's somebody else who's actually selling a call option. Okay, so like there's got to be a buyer and a seller. Now, what does the seller believe? The seller believes that the price is going down, because if he thought that the price was going up, he'd never sell you the option, right? He thinks the price is going to go down. He's one of these 𝗟𝗏𝗃 guys. He's one of these negative guys. He thinks the price of the asset, and specifically in this case Bitcoin, is going down. Okay, so he says, what does he do? He sells you the option. You see, he's this guy over here. You pay him $5,000. You pay the $5,000. He's the guy who's getting the $5,000. So on day one, he's got $5,000. Before we even start, he's got $5,000. Okay, if the price of Bitcoin goes down, then you're not going to exercise your option. So he keeps his $5,000, right? If the price goes between 30 and 35,000, well, he starts losing his premium. He starts losing a bit of his $5,000. Now, if the price goes above 35,000, your profits become his losses. And remember, I said to you, you got unlimited profits. He's got unlimited losses. So imagine his chart basically looks like this, and then goes all the way down with unlimited losses. So that is the difference between a call option buyer and a call option seller. A call option buyer is bullish, and a call option seller is bearish. Okay. Now let's look at a put option. So remember, what is a put option? A put option is the right to sell an asset at a certain price at a certain point in time. So why would you want to sell an asset at a certain price at a certain point in time? Well, simple. If you're worried that the asset is going to go down in value, you may want to protect yourself. So let's just imagine that you're holding a Bitcoin today. You've got a Bitcoin. It's 27,500 or 28,000 as I look at the screen right now. Here it is. And you are scared that the Bitcoin price will drop below $25,000 at the end of the year. And you're saying, look, I can stomach losses, but if it goes below 25,000, that's too scary for me. I can't stomach a loss like that. But what you do is you will buy a put option. And that would give you the right to sell Bitcoin at a certain price at a certain point in time. So let's have a look here. So a put option buyer is concerned. He's worried. He is willing to pay. And let's just look at the put option side of it. So that's the put option side. And let's just look at a put option at $27,000. Okay, so $27,000 or $25,000 just for fun. Or let's say $27,000. So you're saying, I've got a Bitcoin and I can't stomach any losses. Well, you can protect yourself by buying a put option at about $5,000. So you buy the put option at about $5,000. Okay, let's look at what happens. If the price goes up, well, you lose your $5,000 because nothing happens. If the price goes up, why would you want to sell your Bitcoin for less than the price is, right? If the price goes between 27,000 and 30,000, or okay, let's just see which price will take these options at 27,000. So if the price goes between 27,000 and 22,000, you start to recoup your premium, and below 27,000 is all profit. So what happened here is, if you invest $5,000, you get unlimited protection. I'll give you an extreme example. If Bitcoin goes to $1 or to zero, and you have bought the right to sell your Bitcoin at $27,000, you've actually saved yourself $27,000 if Bitcoin goes to zero. So I'll show you an example of how this looks on a chart. So remember, you pay $5,000 for the option. So as long as the price is high, you don't want to exercise your option to sell your Bitcoin at a certain price at a certain point in time. You don't want to do that. But if the price starts to drop, say, but here I said 30,000, but we said 27 now. If the price starts to drop below 30,000, you start making money. But you only break even when you recoup the option price that you paid. And then all the losses right through to zero are actually covered by this option. So if Bitcoin goes to zero and you've got an option to sell your Bitcoin at $30,000, you make $30,000, but you've paid $5,000 to buy that option. And so your net profit is $25,000. And so you can see that you can actually protect your portfolio and sleep better at night, let's call it that way, by just using options. And again, it's not like going short on leverage, because the problem with going short is if the price starts to go up and the price goes up uncontrollably, problem is that you're going to get liquidated. In this case, no one cares what happens to your portfolio. No one cares. No one cares what happens in between. All we're looking at is the strike price. So I want to show you a few more examples just before we go today. And what we'll do is we'll do a few of these on other Sundays. I see a lot of people are saying it's like leverage. It's not like leverage, because leverage means that you can get liquidated at any point in time. There's a point today and there's a strike price, and we don't really care what happens between now and the strike price in the two examples that I gave you. So let's look at a couple of examples. So this is protecting your portfolio with put options. So if you've got a portfolio of 10 Bitcoin and you're worried the price will crash, you know that the price today is $27,500. So the value of your portfolio is $275,000 because you have 10 Bitcoin at $27,500. Then you want to protect that portfolio. What do? Well, you buy 10 put options at $5,000. So you've paid $50,000 to protect a $275,000 portfolio. Okay. If Bitcoin goes to $10,000 and you weren't protected, you would have lost $175,000. But you were protected, and now you can sell your Bitcoin at $270,000. So what do? You lose $5,000 plus the $50,000 you paid for your option. So you lost $55,000 instead of losing $175,000. So you can protect your portfolio actually using these options, which is huge. In fact, all big funds and all big fund managers use this as one of their primary tools to protect themselves against downside. And if you think that there's going to be a catastrophic event, say, I don't know, you're worried about the FOMC meeting, or you're worried about the interest rate decision meeting, or you're worried about the CPI data, well, you can just take an option to hedge your portfolio against that specific risk. In that case, what you do is you'd go to the date that looks closest to when your risk is going to be realized. So you say, okay, well, if I think that the FOMC meeting is on the 7th of April, the 6th of April, I would go and look at the closest one to the specific event that I'm looking to protect myself against. All right, so that is how to protect your portfolio using options. Now, remember I said I'd teach you how to protect, how to speculate, and then how to collect fees. So now you know how to protect yourself. You look, if you're holding a portfolio, you go to a future point in time and you buy put options to hedge your portfolio against an event. Someone says, yeah, brothers, I'm long everything. Yeah, you're long everything. But what happens if it goes against you? You have a serious problem. All right, so let's now look at another option. And the next one I said to you is I teach you guys how to speculate using call options. So what's the story here? The story says you want to buy 10 Bitcoin, but you can't afford it. You just don't have the money. But you want to get the upside of 10 Bitcoin, but you can't afford it. You don't have $275,000 or $280,000. So what do? You buy 10 call options. It'll cost you, let's just see what the price of the call options is. It's changed a bit since I bought it, since I started this video. It cost you about $6,000. So it's just slightly more. So you buy 10 call options at $6,000. If Bitcoin goes down, well, you lost your $60,000. And that's all you can lose. You can't get liquidated. You can't get more. You can't lose more. It can't eat into the rest of your accounts. But if Bitcoin goes above $27,000, you effectively get unlimited upside. So if Bitcoin goes to $1 million or 100,000, let's just say $100,000, because that's maybe more realistic. In your option that you paid $60,000 for is now worth 10 times $100,000, $1 million less Bitcoin's price today. So it shows you that you can use the options to buy something that you ordinarily wouldn't have had. And then I want to show you lastly an example, and then I'll show you some actual spreadsheets just for fun, but collecting fees using options. So sometimes you can just collect fees. So if you're one of these negative guys and you think that the price of Bitcoin is going to go down, so your name is 𝗟𝗏𝗍𝗏, and you think that the price of options, the price of Bitcoin is going to go down. And you're so confident, you're a hell of a confident that the price of Bitcoin is only going to go down. Well, put your money where your mouth is and sell some call options. Sell the right for someone to buy Bitcoin at a higher price at a later point in time. And if you're so confident, well, you know that it's not going to happen, right? So what happens? You sell 10 calls and you collect $60,000. Now, if Bitcoin goes below $27,000, you just keep the $60,000. Okay. Problem is that if Bitcoin goes above $27,000, you now have to deliver those Bitcoin. You have to deliver the 10 Bitcoin. And if Bitcoin gets to $100,000, you have collected $60,000, but you now need to go and buy 10 Bitcoin at $100,000. So, you need to go and buy those Bitcoin. So that's why I say you got to be very careful, because in this case, if you're selling just to collect fees, you got to be really, really, really confident that you're getting it right. So I hope that that's simplified it for you. I do want to show you just a very cool calculator that I made, which I will leave in the description below. But I just want to show you this because I think this is where it all comes together. So let's say that we're looking at a strike price of 29 December 2023 and a strike price of, let's look at what the strike price is, 27,000. So the cost is 6,364. You see that? 6,364. By the way, options actually, you don't have to wait until the strike price to sell your option. You can trade your options live in real time all the time. It's actually a tradable instrument. And you can see when I was making this earlier, the price of the option was $5,000. But because the Bitcoin price went up, the same option is now trading at $6,000. So there's a lot of people that actually just speculate on options prices. So if you think Bitcoin's going to go up, then just buy the option for 5,937. And if it goes up by 1,000, then the option price will go up by at least $1,000 as well. So it's actually a tradable instrument, right? So anyway, let's go back to our spreadsheet and I'll show you how cool the spreadsheet actually is. So let's say that I want to buy an option. I pay $6,000 for a $27,000 strike price on the 29th of December, 2023. Now let's look at what happens here. If Bitcoin goes to $50,000 at the end of the year, okay? What is the total profit that I would have made on Bitcoin? Let me just change it because I've obviously been using an ETH calculator. Okay, let's just change that to ETH. Okay, so if Bitcoin goes under $27,000, our options expire out of the money and they're useless. But then, what happens if Bitcoin goes up? So if Bitcoin goes to $50,000, then I'm going to make $23,000. I'm going to make $27,000 less the cost of before. Okay, yeah. So if Bitcoin goes to $50,000, I'm going to make $23,000, but I'm not going to make the full $23,000 because remember I paid $6,000 for actually buying that option. So I'm actually going to make a profit of $17,000. Okay, so Bitcoin moved up 85% from $27,000 to $50,000. Bitcoin only moved up 85%. But look at what's happened to the value of my trade. Okay, so I paid $6,000. My only exposure was $6,000. And I got a return of $17,000, which means I got a 283% return, which is about 3.5 times the return I would have got from buying spot. So it just shows you that you get the same effect as leverage without actually leveraging, which is why I like it. Okay, and I'll show you the same thing with puts. So in fact, let me show you a hedge strategy. I think the hedge strategy is brilliant. So if I've got 10 Bitcoin and the price today is 27,500, the value of my portfolio today is $275,000. Now I can take I can buy a put option at $5,000 for a strike price of $27,000 in a year. Now that would mean that the maximum amount that I could lose is $50,000. So if Bitcoin goes to zero, theoretically my portfolio would be worth zero, but that wouldn't happen because I have the right to sell my my Bitcoin at a certain price at a certain point in time. So that's the beauty of options. And I want to leave it here for today. And I think what we'll do is next week or the week after, we'll do the next part of it because there's brilliant strategies that you can use. But for now, all I want you guys to do is I want you guys to go and open an account at Deribit. Use the links here. The link is here. use the links here, get an account, and just start messing around buying and selling options. Let's go one step at a time. For now, just learn how to use the options, how to select a certain strike date. If you want to have some fun, then they've got a section called tools.deribit.com, and here it actually helps you which options you can buy. So look here, you can say, I think the price will go up, and so the first question I ask you is, do you think Bitcoin will go up or down? So like I say, I think it's going to go up. Do you think the price will go up within a week, within a month, or within more than a month? So let's say within a month. Okay, and it gives you which options you can buy and what the probability is of returns and stuff like that. So you can do that. So I think for now, for this week, you know the basics. And if you don't know the basics, just go back and watch this video again and share it with your friends. And just get familiar with the platform. And in the next couple of weeks, what we'll do, either on the shows or on Sundays, on Sunday school, we will learn a whole lot of option strategies. And what I think you'll realize is that options are much smarter than playing leverage. They're much smarter than playing futures, because you ain't going to get liquidated. Someone asked, are there cheap futures? Well, cheap options, yes. If you go to ETH and you can see that you can get options for as little as 89 cents. Okay, I'm just giving you an example. So the idea is just to put money into your account, which will reflect in your wallet. And you can see that if you want to trade Bitcoin options, you need to have Bitcoin in your account, not dollars. And if you want to trade ETH options, you got to have ETH in your account, so not dollars. That's how Deribit works. By the way, Bybit also have options, and those options are USD settled. But in this case, I think we're going to stick with Deribit because they are the oldest and the most reliable and the biggest crypto options platform in the world. All right, so listen, I'll see you guys again tomorrow. Remember, Miles is about to do a show. I think he's doing a show on airdrops. Let's just see what Miles is doing. So remember to join Miles on his Sunday marathon shows. Yeah, I think it'll be up in a couple of minutes. He's doing it around options. Share this with your friends. It is one of the educational videos that we're making on Sundays. I have coming on a Sunday to make you guys smarter, to make you guys master traders. So share it with your friends. Leave us a comment below. Like this video. Let us know what we can do different. Otherwise, I'll see you guys again tomorrow. And hopefully tomorrow we can have some good fun trading, because it does look like Bitcoin wants to break this $28,000 level. Until then, have fun and trade well, my friends.